Go over to the CME now. Rick Santelli joins us for the Santelli Exchange. Rick.
Thanks, David. I'd like to welcome Jerome Schneider. Wish he was in person, and hopefully sooner rather than later that will occur. He's the head of short-term portfolio management at giant PIMCO. Jerome, welcome. Let's get right into it, buddy. Yesterday, we listened to Chairman Powell talk at great length about how he's going to keep interest rates low for the foreseeable future, potentially for years. And my question is, why should investors think that's necessarily a good thing? It didn't seem to generate a lot of horsepower in the economy under Bernanke and Yellen. The wait and see and keeping rates low seems to take any sense of urgency out of the equation. Your thoughts?
Well, yeah, absolutely. As you know, monetary policy is multifaceted, and I think that the Fed ultimately did yesterday was keep their optionality open. I've said this many times before, but it's a long road till we get through this healing process, and they recognized through their summary of economic projections that rates have to be low for a very long time until late 2023, maybe even beyond. But there's a second component, that there's many tools in the arsenal, and Jerome Powell did a great job reiterating that yesterday, combined with the fact that they really sort of underemphasized one of their tools, which was the additional purchases or the ability to ramp up additional asset purchases in the future. And that's sort of in their back pocket. So rates is important. Most importantly, that zero rates are here for a long time. So as investors, as cash managers, as savers, the high savings rate is actually going to have great implications for us over the next 3 to 5 years simply because the benchmark rates are low. But the Fed still has policy measures that it can use to help stimulate the economy, help resolve the jobs, and more importantly, get that inflation rate to 2% and above, which is the road that they paved that's going to be very long and methodical as we go through the future.
Well, Jerome, doesn't that make your job as a trader of the short end that much more difficult? If the Fed can buy $80 billion a month of treasuries, $40 billion a month of mortgages, but if they decide they could double the number or they could cut it in half, aren't they pretty much putting rates where they want them? Doesn't that make trading sort of obsolete?
Well, perhaps difficult, but not impossible. And I think that's one of the key things here is rationalize the fact that even though rates are low at this point in time, that doesn't mean there's not opportunity. There's plenty of people who have high amounts of cash on the sidelines. There's plenty of people who want to be defensive given the economic uncertainty. And really what we're focused with here is the opportunity to have total returns in the short-term space. Sure, a Treasury note maybe not appealing to people at 12 basis points for the 2-year note, but there's different opportunity sets that we can actually look to at this point in time. More importantly, I think what investors have to think about is this shadow savings that's out there right now. What I mean by that is the high amounts of cash that are basically being put into money market funds, earning 0%, and investors are simply looking to move beyond that. So the challenge is not necessarily for us as portfolio managers, but it's for investors to recognize the fact that there's a secular view that rates will be low, and they're going to have to actively manage and more methodically manage this shadow savings that's going to move out of money market funds into other realms of fixed income to look for this yield. So definitely difficult, but not impossible, especially if you have degrees of freedom in your portfolio. And that's the key to success as we embark upon this zero rates for quite some time.
Now, we're just about out of time, but it would certainly seem to me that the savings rate being high would exactly negate all the logic behind zero rates. You want to basically make money more active and help the economy get more vibrant, even with the COVID restrictions. We only have a few seconds. Just maybe you can answer that thought.
Sure. Clearly, high savings rates are a symptom of where we are in the economic cycle. As the economy improves, should the Fed likely be successful, you'll see that savings rate naturally come down. But it's not going to come down quickly. And investors need to plan for these savings rates, higher cash balances in their pocket for a foreseeable future. And that's really the focal point of the monetary policy right now, is pushing people into other ways of managing their cash allocations.